Welcome to the program. My name is Marty Schenkman, and I'm joined today by Jonathan Blotmacher and Robert Keebler, and we are going to talk about and help you plan for, on an urgent basis, the House Ways and Means proposal. And I'm going to ask Bob to kick it off first with just a comment about where we stand and what the latest developments are. This is a hot potato that will continue to change at a rapid pace. And anytime there's a change, we're going to try to bring you an updated webinar so you know what to do, because time may be very limited and you need to know what to tell clients, what to do, and how to plan. Bob, what's the latest?
Well, we have draft legislative language from the House, which is basically past the committee. We do not have any draft legislation from the U.S. Senate, and we may not until it goes to the Senate floor. So that's the big issue. The Senate and House have different ideas. Jonathan and I spoke about this a little bit earlier today. So we know there's considerably different ideas between the two. Basically,
Bob, wasn't there a discussion between the House and Senate where I had heard, maybe it was just rumor, that they had come to some agreement as to what they might do to reconcile all of this?
That was last evening that the Speaker, or yesterday afternoon, that the Speaker and the Senate leader, Mr. Schumer, said those things. So, but again, this is continuing to evolve. That's leadership's agreement. That's not what Van Hollen wants in the Senate. That's certainly not, we don't know how much Wyden's thumb was on that scale, Chairman of Senate Finance. So we have to work through all those things. Undoubtedly, we haven't seen the final version. What is maybe most concerning of all this, and I'll let Jonathan speak to this, my understanding is some very prominent members met with people yesterday and came back with some really kind of ground-shaking news that maybe that they believe that some of these statutes have technical problems, and it's really worse than it looks. Jonathan?
Yes, some leadership met with the staff of the House Ways and Means Committee. Now, as Bob said, we did have a draft come out of the Ways and Means Committee, and that provided certain what we call grandfathering rules with respect to the recognition of gain and also with respect to estate tax inclusion, specifically with respect to grantor trust. One of the most significant proposed changes made by several people is that a grantor trust would be includable in the gross estate of the grantor at the time that the grantor died. Very, very far reaching. That's a new provision, or would be a new provision. But that was made only prospective. So if you had a pre-existing grantor trust, unless you'd made an additional contribution, it would not be in the gross estate of the grantor. In addition, there's a provision that basically says if you have any transaction between a grantor and a grantor trust, which under Revenue Ruling 85-13, and there's even something in the regulations under Section 1001 says, that's ignored. You just pretend it didn't happen for income tax purposes. Very far reaching, and led to things such as a so-called note sale or an installment sale to a grantor trust, where there would be no gain recognition because the official position of the government is that the grantor still owns the assets in that grantor trust. That was going to change, but again, only on a prospective basis. Pre-existing grantor trusts would be grandfathered from that. The people came back and announced, well, the staff says that they did not intend to provide that if you had a pre-existing grantor trust, that you could have transactions with it between the grantor and the grantor trust, and those transactions would be ignored. That's exceptionally far-reaching. And as we may get into it, it also means that if you have even a pre-existing grantor retained annuity trust, where the annuity would be paid by distributions of non-cash assets, like appreciated assets, to the grantor in payment of the annuity entitlement to which the grantor is entitled under the grantor retained annuity trust, that would become gain recognition, even if it's a 5-year-old trust. At the time you created it was very clear on the official position of the government, and it was an official position, that there would be no gain recognition. Gee, we decided it was too much to give away to wealthy taxpayers. but that is exceptionally far-reaching. And it also means that anyone who is planning to do a transaction in anticipation of changes being effective only on a prospective basis has to rethink that. Because, for example, if you're doing a GRAT, say a 2-year GRAT, and you're going to make distributions of appreciated property in kind in satisfaction of that annuity, you're not going to be able to do it. Now, how that will all shake out, we have a huge way to go. As Bob was indicating, not only do we have to see what will eventually come out of the House and Ways and Means Committee, understanding that the Ways and Means Committee has said, well, we're not finished drafting anyway. There are certain aspects. So eventually something will come out of the House Ways and Means Committee. It will then go to the floor of the House, and Nancy Pelosi, the Speaker of the House, has said, we are expecting additional changes, basically on the floor. Once the House passes it, it will go to the Senate. And I can assure you the Senate is not merely going to rubber stamp what the House did. You have people, as the guys were indicating, Chris Van Hollen, the senator from Maryland. You've got Ron Wyden, the senator from the state of Oregon, and who is the chair of the Senate Finance Committee, who has very, very far-reaching notions of changes in the tax law. And you also have Bernie Sanders, who got a lot in the House draft of what he wanted, but not everything he wanted. So you can anticipate changes. Once those changes are made by the Senate, those bills will be different, and they go through what's called a reconciliation process, where representatives of the House and representatives of the Senate get together and they work out a compromise. And by the way, it doesn't mean they have to adopt anything exactly what the Senate or exactly what the House has proposed. They can kind of come up with their own. And in every circumstance that I'm aware of, and I've been watching this for over 50 years, the Senate and the House will adopt whatever the Reconciliation Committee comes up with. So we simply don't know. Now, as a matter of timing, and I'd like Marty and Bob to weigh in on this, people thought this might happen next week. I think it will be fortunate if it occurs by Halloween. Some say Labor Day, Thanksgiving Day, and some say it won't happen until the middle of December, which happened with the Tax Cuts and Jobs Act of 2017. I think that passed. It was signed into law by President Trump on December 17. Again, it only has to be done by the end of this year. In fact, because it wouldn't be a new Congress, things would actually be adopted next year and maybe made retroactive. Marty and Bob, when do you think these things might happen?
I don't know that we have any clue. I mean, you've kind of given a wide swath of possibilities. A client of mine trying to get a handle on when this may happen sent me to some betting website. I didn't even know such a thing existed. And you can actually see odds of when the bill will be enacted, the date of enactment on this betting website, and you can place bets on it. I thought that was pretty interesting. And that betting website, when I looked at it with the client, now forgive me, I don't remember the name of it, had a 52% odds that this would be enacted by November 1. So the people putting down real money, Jonathan, seem to feel it may get enacted earlier than you do, but that may have changed. I don't know that we have I don't know that there's a benefit to us to speculate when it may be done, because the bottom line is even Thanksgiving is really soon for planning in progress. I think what we have to do, which is different than a presentation Bob and I spoke on, I think Monday, is given the comments based on ACTEC's discussion with people in Washington, we have to be very mindful that some of the planning that we talked about as recently as Monday may not be optimal. So, you know, it was possible for somebody to make a transfer to an irrevocable trust now and then plan on doing a swap later if they couldn't get the, like a lender approval or something, or whatever other prerequisites dealt with. And that may no longer work, because post enactment, we could have a realized gain from doing that. Doing a GRAT and planning on paying back with appreciated assets, as you said, may not work. And we had talked about using GRATs for anyone that had used up all their exemption, as a possibility of trying to freeze further asset values in the estate. And that comment, which I know is unofficial, but it's certainly significant, that even pre-existing trusts and even pre-existing transactions, because funding a grant today would still trigger gain under the way you described it. So that
Well,
requires
Marty,
us to rethink what we're doing.
Marty, I'm not sure that if you funded a grant today, or you funded a grantor trust, or you did an installment sale to a grantor trust, that you would have gain recognition today. I don't think that's the case. I think
No,
even
that's not what I said. I said that if you fund a grant today and post enactment make a distribution of an annuity in kind with appreciated assets, based on what you related that ACTEC heard, that would be a taxable gain, even though the trust itself and the transaction predated enactment, because the actual payment of appreciated property would be, or the swap would be post enactment, and it would no longer be deemed between the grantor and a grantor trust. It would be deemed to be between the grantor and a third party. Did I not hear you correctly?
Well, I thought you were saying that even the transaction of setting up the grant today would
No.
be taxable, and you and I are in agreement that that's not what's been proposed. But of course, Marty, that could happen, because Chris Van Hollen came out with a proposal that would make it taxable, because he would have any transaction of appreciated assets during lifetime or at death be a taxable event. So, and he wanted that retroactive to the beginning of this year. Now, a lot of us said, well, Joe Biden didn't propose that, and the House Ways and Means Committee didn't propose it, so it's likely not to happen. But again, as we've discussed, regardless of what the House does, it will go to the Senate. The Senate can have its own ideas, including effective date provisions. So
and that all may change.
That all may change. Bob, what do you think?
Well, I think the important thing is, so we have this 3 or 4 dimensional issue. There's, will the Van Hollen bill become law, and what will be the date? And then there's the income tax implications of all this, along with the estate and gift. Here are my questions. So anything, we realize that idiots and grats are really not worth talking about after the president signs the current bill. They're done. I think we all probably agree on that. And we'll have to fall back to taxable installment sales, taxable gifts, unified credit gifts. We're in this limbo period right now. And let's just examine a 2015 grat, Jonathan, or Marty, a 2015 idjit. So what we're hearing is that 2015 10-year grat would truly not be grandfathered for income tax purposes. It would be grandfathered for estate and gift, but not for income tax. So when the payments come from you as the trustee, Jonathan, back to Marty as the grantor, they would be taxable payments, correct?
The interest would now be taxable, won't it, on the note?
No, I meant in the grants. So the grant has Apple stock with a basis of $1, fair market value of 100, and it gives you 50 shares for your annuity. I think that is going to be a taxable event from what Jonathan heard yesterday.
That is correct, Bob. That would be a taxable event to the extent of appreciation in the assets distributed in satisfaction of the annuity. Now, Marty, that's interesting. What about interest on debt?
We haven't talked about it. I haven't heard anyone talk about it, but it's even worse than that. So somebody that hasn't refinanced a note with an old grant or trust sale transaction, if they wait till after enactment, will that be a taxable gain?
I don't think we know what it will be. It did acknowledge that it would have to provide some sort of relief for, we'll call it grandfathering. For example, take Bob's 10-year grat that was set up in 2015, and now we have a payment, let's say in 2022, and we do it with appreciated assets. Are we going to wind up having that be a taxable event? It's pretty harsh to say if you'd set up something way before even the presidential election of 2000, that you should now be caught by a change in the law. It could happen, and I think constitutionally that probably would be upheld, but it would really be a shock to people who were told, and the Treasury agreed, that there would be no adverse tax effect of paying an annuity from a grantor trust to the grantor. But we'll have to see what happens. And by the way, I don't think there's an awful lot of money in that. It's really a question of posturing. do you say we're so angry at the wealthy in this country that they've gotten away with so much that Bob's deal, I've gotten 7 years of tax-free distributions of assets in kind. The fact that I'm now going to have to be taxed on 2 or 3 years after the bill is enacted, well, that's just the way the cookie crumbles. You got 7 years. Theoretically, you shouldn't have gotten any because it was abusive under the system, but the system allowed it. And remember, one of the great things about the United States, we are a nation of laws. And one of the best things is that you can rely on the law, and that allows people to go forward with transactions because they know I've done my transaction now. This is the way the law is, and it's not going to be changed. Unfortunately, the tax law allows the Congress to make a lot of changes that are retroactive, and that could be extremely harmful to some people who acted in good faith. So my guess, and I'm guessing only, is there may be additional grandfathering for certain pre-existing trusts.
Why don't I think the really relevant thing to what we're talking about, and this has changed since Bob and I did a webinar on Monday because of these comments from the committee, is what do you do with planning now? And it sounds like one of the things that we've all stressed on all the programs that we've done, you got to plan fast, and you want to move and get this stuff done before date of enactment. I think that clearly remains something that we need to advise clients to do, and we need to try to do, get planning done now. But I think it also, the comments that we've made, and let me make a few observations and then you guys should jump in. So one, I think clearly we got to get planning done ASAP. If a client's contemplating a grad or a note sale, we need to do it. But the comments that you've made suggest a couple of other things to me. We've talked, and it's varied as the news from Washington is varied, but I think for a while we've been pretty consistently suggesting that people want to build in ways to unravel a transaction. And then when the House proposal, the Ways and Means proposal came out, we may have thought we could breathe a sigh of relief that it would only be prospective from date of enactment. Not that that gave us a lot of time, but at least that prior transactions were safe. Now we're not 100% sure of that. So the same advice we've been giving for a long time is build in mechanisms, and we should come back and elaborate a little on this, Jonathan, to unwind a transaction, disclaimer provisions, renunciation, formula clauses. We should build all of these things in because we don't know what's coming down the pike. And just as you explained, Jonathan, it's almost like anything can happen between now and the end game when something is finally enacted. So I think all the things we've been talking about probably since last year of flexibility, formula clauses, disclaimers, rescission, all that needs to be built in, and we should take a few minutes later in this program and you know, kind of recap some of that for those that aren't familiar with what they can do with it. Second, it sounds like, and this I'm just thinking off the top based on your comments on ACTEC's interaction, Jonathan. If I have an old GRAT, like Bob suggested in his hypothetical, a GRAT from 2015 that's got appreciated Apple stock, maybe what I want to do right now before enactment is swap some of the Apple stock for cash and infuse enough cash to cover some of the upcoming annual annuity payments. So if I have a 6-year grad out there and there's 3 annuity payments left, maybe I want to put enough cash in there so that post enactment I can pay the annuity without using an appreciated asset. That's something we've never done. Now the concept of infusing cash and trading it, swapping it, or buying for appreciated assets inside of a grad, we've referred to historically as immunization. But the concept of immunization historically was that Apple stock has gone from $1 to $100. Let me freeze the value inside the GRAT, so in case the value declines, I've locked in my estate tax benefit of the wealth transfer. But we're now talking about a similar application, but for a very different purpose, that if post enactment using appreciated assets could trigger capital gain. And by the way, folks, not capital gain at 20%, but capital gain potentially at 25%, along with the 3% surtax, which has also been talked about, and the 3.8% NIT tax. So that's a pretty costly gain to pay out an annuity payment. So maybe we need to go back to clients with existing grants and evaluate a traditional immunization step, but for a purpose of avoiding these transition rules of post-enactment gain being realized. Maybe we need to make sure every client that hasn't refinanced a note inside a grant or trust does it before enactment. We were really looking and focusing on getting assets transferred, doing new note sales, but maybe what we need to do is make sure anyone that can or should refinance does it, because it's possible, from what we were talking about, and Jonathan, jump in if you disagree, it's possible that the interest payment on those notes, if what they just talked about without relief for grandfathering, the interest payments post enactment could be taxable. Not that that would be the end of the transaction, but certainly if we can lower the interest rate, that might be beneficial.
So Marty, I think then the essence is we have two immediate priorities. One is transactions, which has been obvious. And the next one is this whole immunization. Can we, for existing clients with existing grants, existing idiots, can we move cash into the idiot and get that low basis property out of the idiot back to our clients? And that may make great sense. Should we go up to the next slide, Marty?
I didn't think we were going to ever change slides. But I think it's important that we take this stuff that we've talked about and translate it into actionable items that practitioners can do now, because that's really what's on everybody's mind. It's great to talk about what they're doing in Washington, but what do I do now? What do I tell clients now?
I think we drive transactions. Keep in mind, we're going to talk about these valuation rules. So there's plenty of motivation to drive transactions from an estate and gift perspective, even if we have to live with bad income tax implications. Now, the person with 90% basis is going to live through this a lot easier than the person with 9% basis, because that person with a little basis is going to have a much larger gain. And you're correct, that gain is 25% plus 3.8 plus 3 if it goes over 5 million for an individual or 100,000 for a trust. And since the trust is the seller, even though it's a grantor trust, I'm guessing we recognize that on the trust tax return. That's kind of up in the air, but you'd really have exposure to that 3% surtax too, Marty.
And
let me
isn't forgive me, and I may be wrong, but doesn't that 3% surtax kick in on trust income of 100 grand?
100,000, right? Exactly.
So basically every transaction, Bob, 25, 3, and 3.8 is how much?
25 plus 3 plus 3.8.
It's 31% effectively.
31%.
That's right. Jonathan's the mathematician on this call.
Yeah, well,
So
let me
that's
mention
a significant cost, and that's before state tax.
Yeah, well, let me mention a couple of things about that. We don't know on these transactions where gain is recognized, whether gain would be recognized by the trust as a separate and independent entity, where you're going to have to worry about that $100,000 threshold to get to the 3% surcharge, or whether because it is a grantor trust, it's going to be taxed to the grantor. And then that 3% surcharge would only kick in if the grantor has total modified adjusted gross income of $5 million, assuming it's a married taxpayer. So we don't know, but certainly standalone, and this is a very big deal, if you have a trust that is not a grantor trust, and it just makes a transaction, it's going to have to pay the 3% surcharge plus the 3.6% net investment income tax, 3.8% net investment income tax, and the potential 25% basic new long-term capital gains tax rate if it has income above $100,000. We simply don't know. That's
Jonathan?
a very important thing. Yes, Marty.
Don't nitpick. That was an attempt at tax humor. Forgive me. Go on.
But
well, Marty, well, let's go on. We have one here that, there's going to be some changes that are going to be important to some people. For example, so-called syndicated conservation easement transactions, where a promoter buys a piece of land, he then gets others to invest in it. They do a conservation easement and they take a deduction under section 170H of the code. basically syndicated transactions would be curbed significantly. And I think that that's very, very likely to go through, although some of the promoters of these syndicated conservation easement programs are lobbying hard in order to maintain it because they make so much money. Remember, as always, it's always in the money. Let's go to our next slide, Marty.
Hang on.
So all that's going on here is there's been a lot of litigation, very nitpicky procedures where supervisors have to approve penalties. And basically Congress is retroactively changing this rule all the way back to 2000 so that the IRS doesn't have to meet these technical requirements. Just know that if you're in the middle of a fight with the IRS about penalties, this avenue may be lost to you. Let's go to the next slide, Marty.
Well, let me mention, Bob, this is again a case of being unfair. I mean, the law did require a supervisor approve the imposition of the penalty, and there have been cases where the taxpayer has said, we didn't get supervisor approval, therefore they can't impose the penalty. And the court said, that's right, that's what the law says. Well, they want to retroactively take away that requirement. I think that's unfair. Is it constitutional? Well, someday someone will fight about that. But this is a proposal which would make it very difficult for some taxpayers. Keeping in mind that the penalties, basically under Section 6662, are pretty much automatic. Even if you've acted in the best of good faith, you can have a penalty imposed, and those penalties are generally non-deductible for income tax purposes. So this could be very far-reaching and could be made retroactive.
Bob,
Hey, Marty,
why don't we
let's go
stay
to
focused
slide-
on estate planning? So why don't you just give a quick thumbnail of slide 6?
All the essence of this is that for people of lesser means, there's a wealth shift from the wealthy to the less wealthy, and that's being proposed in the form of child tax credits, credit for dependents, earned income credits, premium tax credits. So that's how basically the wealth shift is being driven, is through the tax law. People will even be able to get greater refundable credits, Marty. Let's go up to page 7, please. Now, interesting for estate planners, in the back of your mind, there's a new credit up to $4,000 for expenses incurred caring for relatives living at home, unable to perform the activities of daily living. All this is, it's a very good attempt at, when I get to be, if I'm lucky enough, 88 years old, and I kind of can live at home, but really can't live at home. It's an attempt for my children to be able to finance keeping me at home, maybe for another 6 months or a year, Marty. And this is just part of that program, but it would be done through the tax code. This would phase out if my income exceeded $75,000. Next
For
slide,
elder
please.
law attorneys, this could be an important thing to use for clients.
And Bob, the 75,000 threshold isn't on the caregiver's income, like a child or grandchild who's taking care of a parent or grandparent. This is the person who's getting the assistance, correct?
I think that's correct, yes. Now,
So,
here's the
Bob,
thing. Go ahead.
yeah, when you go through the rates, let's really emphasize so people get it, because this is going to come up in a lot of the upcoming slides. The almost attack on trusts. We've talked about some pretty harsh rules already that impact trust planning, but now that's going to be compounded by income tax planning. And for those of you on the call, please also think in mind of the Secure Act, and we're going to tell you what the impact of this is on some of those distributions from IRAs, because it's going to be significant. Bob?
So on the pure income tax, ordinary income, once you hit 450 for a married couple, you're going to be in 39.6. The cutoff will be 12.5 for a single individual. I'm sorry, let me say that again. 12.5 for a trust. That's what Marty was trying to emphasize. So at 12.5, inflation adjusted, we'll hit the 39.6% rate. Now, a single person, 400. What's going to transpire here is, my prediction is there'll be a lot of Roth conversions between now and the end of the year. Not driven by any of the other IRA changes we're going to talk about, but primarily it's going to make sense for people to do Roth conversions to thread the needle, Jonathan, at 35% or 37% instead of 39.6. Now, for very wealthy people, extremely wealthy, there's another motivation. So I have people with 10 million in their IRAs, and their RMD is like $300,000 or $400,000, Marty. And they might have other sources of income. They're going to be in the highest bracket possible. So we do want to talk about Roth conversions. Remember, for trust though, there are a number of changes for trust. So number one change for trust, everybody write this down, is number one change is we're going from 37 to 39.6%. That's the number one change. Now, we created two priorities on the last couple screens ago. One is immunization and two is getting transactions done. When all of that's done, the third thing for T&E lawyers is to immediately get with the CPAs and financial advisors for every trust you represent, and together figure out how all of these new taxes, the surtax, the 39.6, are going to impact that trust, and what will be your D&I plan going forward. Now,
Bob, let me interrupt one section. Obviously, if you have a trust and you have significant income, you're going to be murdered on taxes. I mean, 39.6 plus 3, again, that kicks in for a trust at just 100,000, unlike for an individual who's married at 5 million. Plus, the good news for distributions from qualified plans on IRAs, you don't pay the 3.8% net investment income tax.
And it's worse, folks. There's more coming up. So don't just get exacerbated now about what's happening to trust. There's worse stuff to come.
For most families, you'd be better off having the income taxed to a family member rather than to the trust. How can you do that? Well, trust provides so many benefits. You don't want to take assets out of a trust because then it's exposed to creditors. And if you have, for example, a disabled person, that person is going to owe money to whoever provides services to them. I wrote an article back in May of 2020 and July of 2020 in Estate Planning magazine. And one of the things I pointed out is that maybe what you want to do is to have things paid to a S corporation, where the trust makes some sort of qualified subchapter S election, which means that the income will be taxed to the beneficiary. Now, you may have to decant your trust so that it would qualify as a qualified subchapter S trust, but that would mean that the physical receipt of the income would be by the S corporation. The S corporation is not going to be required to make a distribution except for its fiduciary accounting income, which by carefully structuring the entities, you don't have to have any fiduciary accounting income. So it will be physically distributed to the S corporation, but the income will be attributed in turn through the trust, through the qualified subchapter S trust, to the beneficiary who would report it on his or her own return. This is a complicated matter, but I urge you to get a copy of both the May and the July 2020 issues of Estate Planning magazine and read about it. It could save your clients tens of thousands of dollars every single year.
Jonathan, it's even deeper than that. What's going to happen because of this 100% surtax and the highest rate, which we'll look at in a minute? People are going to shy away from trusts, and they're going to give up all of the great asset protection things that you and Marty always talk about. This idea of using the S corp keeps both the accountant and the lawyer happy. The lawyer's happy because clients are getting their asset protection, property law issues, and of course the accountants are happy because that income is going to individual returns where it's taxed at lower rates rather than at these higher rates. Now let's transition to capital gain. Any sale after 9/13/21 subject to capital gain at 25%. There is a rule for basically binding contracts, and that's going to be a binding contract under relevant state law. So we have a binding contract under relevant state law. Marty, let's go up to the next slide.
Bob, let me ask a technical question here. That binding contract, would that also include, say, a tax-free reinvestment under Section 1031? So if I have a binding contract, or let's say I'm just in the process of doing a 1031 transaction, am I going to be grandfathered from the higher rate and be able to do my 1031 to the extent I can't do it tax-free? Or is there going to be an additional rule, do you think?
There'll have to be some type of regulation or guidance addressing 1031s, but I think if I have a binding contract to sell building A, well, if building A is already sold, you would think that you'd be able to use the rate in effect when that was sold. But that's going to be the $1 million question that we just don't know the answer to quite yet. But we'll look at that, Jonathan. I'll put that on my notes of things to look at 1031s and the binding commitment exception. So 3.8, Marty, what's going on here is it's actually very easy to understand. Let's say that you and Jonathan are brothers. Jonathan's working in the car dealership up in Albany, where you guys grew up, and you're down in New York being a lawyer. You own half the business, Marty. Right now, you've been paying the NIT for years, but Jonathan hasn't. This is going to change it, so Jonathan has to pay the NIT on his S Corp or LLC earnings from a business that he materially participates in. And that takes the advantage of the low salary game that everybody plays, where you earn $5 million in your S Corp and take out a salary of $30,000. That game is going to end real quick. These are the thresholds. Note the threshold.
Bob,
yes.
You meant that planning technique. You didn't mean to say game, correct?
That strategy, right?
Yes.
That strategy. Thank you for the clarification, Marty.
Well, let me just add for purposes of clarification. Bob says that this strategy is that you take out only 30,000 as salary. That's subject to the 3.8%, FICA tax, and the balance of the $5 million is going to be taxed to you, but not subject to that 3.8% tax. That will change. So even though you wrapped yourself in an S Corp and have been able to minimize the amount of FICA in effect or net investment income tax you pay, that will be ended. As Bob says, that game will be over. Marty doesn't like the phrase game, but that type of transaction would end under the bill.
That's
Now,
exactly.
just keep in mind, everybody, that what might happen is clients may want to reconsider the choice of entity when this is no longer a feasible planning construct. So they may want to change their choice of entity. Also consider how this may impact buy-sell agreements. So if you have an S Corp and there's two partners, Jonathan and Bob, and they're taking out what they deem reasonable salary, and they hopefully have some analysis or rationale for what reasonable compensation is, and the excess was taken out as distributions to avoid FICA, it may be that the formula in their buy-sell was pegged to some earning figure, and that may all now change. So just be mindful, there could be a lot of unexpected ripple effects from this that we're going to have to take a look at. Now, that's not something we're under pressure to deal with now, but just keep that on the radar probably for next year.
And let me mention that it appears as though they're going to allow you to convert from S corporation status to partnership status tax-free. Exactly how that will work out, we don't know. But, the big advantage of S Corp compared to a partnership has been this ability to avoid the 3.8% tax. But if you're going to pay it anyway, a lot of people would prefer to be taxed as a partnership rather than an S corporation. Although, as I said, if you're making distributions with respect to trust, you may be better off having it paid to an S Corp, which is in turn owned by a qualified subchapter S trust, which can only have one beneficiary, and then that income would be imputed to the beneficiary who may well be in a lower bracket. This is complicated stuff, which you're going to have to carefully consider with your clients and with your clients' CPA and other financial advisors.
So with the next slide, I'll let Bob explain it, but let me just introduce it. This is yet another, and I'm going to just call it the way it sounds, it's just another attack on trust. It seems pretty clear that Congress does not view trust as a tool that people use to protect themselves or heirs from liability, divorce, mismanagement, but rather a tool that the wealthy use to abuse the tax system. So we've talked about the $100,000 income level for the 3% surtax as contrasted to a $5 million level for individuals, around 12.5 before you get into the maximum 39.6% bracket, plus the potential for NIT, etc. Now here's yet another very costly issue on trust. And one of the questions becomes, for a client that will qualify for a significant 199A deduction, does this dissuade them from using trusts? And Bob and Jonathan, after Bob explains this, do we want to swap some, for example, rental real estate properties out of a trust so that we can get a better 199A deduction? Bob?
Well, that's a big consideration. So 199 will be fundamentally changed. Let's look at this first through the eyes of a client of yours. She's a dentist. She's married. She earns $500,000. She is going to receive absolutely no 199 cap A deduction. It's going to phase out. Starting at 400,000 from the journey from 400 to 500, you would have a phase out. So Marty, at 400,000, she would pay tax on 320. At 500,000, she pays tax on 500. That extra $100,000 of earnings, true earnings, generates $180,000 of taxable income. So there's going to be a lot of people towards the end of their career, once they understand this, will make every effort possible to keep their income at that $400,000 level, so they don't have to pay basically a 65 to 70% federal rate on that additional income. Now, in the world of trusts, the cutoff here is going to be at $10,000. No more 199 deduction. So I represent this family. Let's call them the X family. They have trusts set up for children, the trust loan real estate. Those trusts are taking very large 199 cap A deductions. That game is over January 1st. So now in the world of trust, from the T&E lawyer's perspective, here's what's changing. 39.6, 25% capital gain rate, a change to the NIT, and now a change to 199 cap A. So as all this stacks up, there's going to be pressure on not to use trusts, and we have to find a way through that. Jonathan's idea of using the S Corp may have great merit, and we'll just have to keep working through this. But that's what's going on. So if a trust had business income, legitimate business income under Aragona of $110,000, they would only get the 199 deduction. Of a maximum 199 deduction they would ever get would be on $10,000. Let's jump up to the next slide, Marty. And business losses, this is a provision in the law that prohibits me from using losses on a business to offset portfolio income. That is going to permanently apply beyond 2025. Again, that affects not only trusts, but individuals. So that's out there. Now, if we go up to slide 12, this is what Jonathan and Marty were talking about. 39.6 plus 3.8% NIT plus 3% surcharge or surtax. Now we're at 46.4%. And in New York, we're almost touching 60. Now the cutoff here is $100,000 for estates and trusts. That's a very low number. Now keep in mind, under the D&I regime of 661 through 663, if we make distributions from the trust to the beneficiaries, we will carry out D&I and then have that appear on the beneficiary's return, in all likelihood not subject to the 3%. But Jonathan and Marty, there'll be a lot of planning that surrounds this. So this is kind of the third tier of the T&E lawyers' immediate concerns of A, immunization, B, transactions, and C, doing trust income tax planning going forward. Any comments before we go further?
I think there's going to be a lot of unhappy clients, and I don't think you're wrong, Bob. I think some clients are going to start to feel uncomfortable when they have non-grantor trusts. And don't forget, the new law, in a sense, almost pushes non-grantor complex trusts. And when they see these rates, they're not going to be thrilled. And yes, you can manage it to some degree by making distributions using Jonathan's Quist idea, but you have an issue. you have an issue. And I think we're going to have more of a challenge trying to do what we've traditionally done, which is default to having everything in trust for as long as possible to protect people. Jonathan, what are your thoughts on how this may change?
Marty, I agree with you. But again, trusts are so important for non-tax reasons, and also keep in mind, we don't know how it will come out. Trusts may provide very long-term benefits from an estate and gift and generation skipping transfer tax perspective as well. If money is going to be passed down from generation to generation because it's owned outright in effect, well, then you're going to have a tax at each generation. If you keep it in trust, if it's exempted from generation skipping transfer tax by exemption or grandfathering, or if you go ahead and you do something like put it in, so you use a concept I developed called generation jumping. We don't have time to go through that. You can avoid those wealth transfer taxes. So this is going to be something that has to be balanced by the advisors and by the client herself in deciding what to do.
And I think that's going to change our conversations with clients. This is going to be very significant. And what Jonathan just discussed is precisely why Van Hollen, for example, proposed that assets in a trust every 21 years will be subject to a deemed realization and capital gains tax. That's why Senator Sanders proposed that a trust can only last 50 years. And those kind of changes would negate the benefits that might remain. We may find that our profession changes even more radically if some of those changes are made along with the whole string of harsh income tax changes we've talked about. We may find ourselves looking at using partnerships and LLCs as vehicles to protect heirs and avoid commingling for matrimonial purposes and provide asset protection, because trusts are almost being made so costly that they may not be viable. So that'll depend on what else comes down the pike with the final legislation. I mean, that would really remake our entire profession of what we've done.
Let me just clarify that Bernie Sanders' proposal isn't to limit trust to 50 years, but you could only get generation skipping transfer tax protection for 50 years. You could still do a perpetual trust in a jurisdiction, but you're going to have to wind up paying tax as it moves from generation to generation. If you want to get protection from generation skipping tax, the trust must end within 50 years. And we don't know what end means. Does it just mean that it's exposed to tax at that time, or does it actually mean that it has to end? We simply don't know.
Now, speaking of ending,
what about this change, Bob?
Well, we're going to go from 10 million inflation adjusted back to 5. And that means next year, yours and your wife's exemptions, Jonathan, will be about 6 million each, give or take. The problem is how it works with integrating prior gifts. So this change will be 1/1/22. And the problem is, Marty, look at the next slide. The problem is we're in a use it or lose it situation. But the ordering rules mandate that we burn our old exemption first before we burn our new exemption when we're making gifts. And there's an illustration on the next slide that really lays this out. Now, looking at this.
Is that this slide, Bob?
Yes, perfect. 17, Marty. Thank you. If I make a gift, I'm taking it from my old exemption first. So if I made a gift of $5,850,000 today, I burn my old exemption, and then on January 1st, I lose my 2018 exemption increase. I would have no exemption left. Just like if I gave away all 11.7, I would have no exemption left. So what we have, if you're trying to optimize this for someone, you can't go halfway. You have to give away their 11.7 and their spouse's 11.7.
Let me just add what Bob is saying, and it's critically important. Let's say your client's never made a gift before, and she says, well, we're going to go down to 6 million in January 1. So I'm going to give away 5 million now. I'll use, 5 million of my 11.7, but I'll preserve the most of the new 6 million as of January 1. You can't do that. If you want to use part of your enhanced exemption today, part of the 11.7, you're going to have to effectively use it all. You can't preserve what you don't use under today's law for the future law. That's pretty clear. That's what the Treasury is going to say. It will come through that way. And that means that you have to consider making very, very large gifts today. And unless you have a client who's extremely wealthy, that's going to be very difficult to do. Most people don't have 11.7 million. Married couples don't have about 24 million. Very few people have that. On top of that, even if they have it, can they afford to give it all away? And I don't know that we're going to have time to go through it in detail, but there are some things where you can try to use your exemption and yet continue to try to benefit from those assets you've given away this year.
And Marty, did you want to back up? I think there might have been a slide before this that you guys wanted to cover.
Yeah, these are some ways in which you may be able to do it. One thing, again, if you've got a wealthy client, the wealthy client should consider using his or her $11.7 million today. It does not appear that you can preserve it by just making a gift today and then saying, well, I'll still have 11 million next year. You're going to have the amount used today or in any prior year applied first against whatever the exemption turns out to be in a later year. You can do gifts now. If you don't have the assets, you could borrow. So you could go to the bank if it would loan it to you, and you could make a gift of that and preserve the rest of your assets. You're going to get a good deduction under Section 1053, but now you're going to have to pay interest. Perhaps you have a trust which could lend you money, and you can perhaps borrow at the applicable federal rate, which even long-term would be under 2%. But you're going to have to, because it's not going to be a grantor trust. If you're borrowing from it, you're going to have to wind up worrying about the income tax effects of that, including, if you don't pay the interest, having the interest accrue for tax purposes. You could do a spousal lifetime access trust for your spouse. So you could go ahead and take your 11.7, put it in trust for your spouse, do it in a domestic asset protection trust jurisdiction like South Dakota, Alaska, Nevada, Maryland, Delaware, or other states, and go ahead and do that so it would be available for your family for the rest of time. As Marty has long pointed out, you are probably better off having one spouse make the large gifts rather than both. So I give away 11.7 million. My wife doesn't give anything away. She will have her $6 million exemption available next year. If each of us gave away $6 million today, we'd have nothing beginning next year. That's extremely important to consider. But you do run the risk if Bob creates a spousal lifetime access trust for his wife, and she creates one for him, then you're going to have to worry about the reciprocal trust doctrines, which means it may come into your estate. The best thing to do to avoid that doctrine is to have those trusts created entirely different times. You can't do that anymore. You've only got, you've got less than, realistically 3 months before the end of the year. So you've got to worry about that. You could also do a special power of appointment trust, or a SPAT. And that's a trust you create for other family members, but some non-fiduciary holds a non-fiduciary special power of appointment to appoint property back to you. And that should work to avoid creditor claims. And in theory, you could even do it and avoid the reciprocal trust doctrine. You can read all about that in the February 2019 issue of Estate Planning Magazine in an article by Abby O'Connor, Mitchell Gans, and me. It is worthwhile knowing about it so your clients can do something for themselves without having to worry about domestic asset protection trust being attacked, because they say it's still subject to the claims of creditors. They should avoid that claim, and it also should avoid the reciprocal trust doctrine. Let's go to our next slide, Marty.
Let me make a couple of comments just to emphasize and elaborate on a few points that Jonathan made. First, what we're going to all face, and Jonathan said, but you got to be careful that we have to the end of the year. We don't. We have to the effective date of any new legislation, but keep in mind what Jonathan said long ago in this program. Those effective dates may change. Von Holland wanted retroactive to the beginning of this year. I don't think he's going to get that, but we got to be very mindful. And if the grantor trust restrictions are effective date of enactment, we don't have to the end of the year. And I think a lot of clients are hearing that. So it's important for us to educate the clients that they don't have to the end of the year. We don't know how much time they have, so we have to move quick. One of the things that I'm sure is going to start happening is, just like in 2012, we're going to be off to the races, and clients are going to be running to general practice attorneys to do anything to use their exemption, and they're going to do the same stuff that a lot of I think largely non-specialists did in 2012, which is set up a trust for kids or a trust for grandkids, or bill the client more and set up a trust for every kid and every grandkid, when in fact they'd be better off doing slats, spats, daps, hybrid daps, because of access. So we need to be very mindful to make sure that we preserve clients' access. I think it's important for us as practitioners to document in writing to clients the comment Jonathan made to protect us. Normally, what we would ideally like to do to help differentiate slats is do them in different tax years. That's the luxury of time is gone. Like Jonathan said, we just want to get stuff done as fast as possible. Tell the client, not being able to differentiate the trust pursuant to a different plan or different times is a negative factor from a reciprocal trust challenge, and we can't do anything about it. We're happy to help clients, but it should be the client's risk, because the client's the one moving millions or tens of millions of dollars, not us. Another risk that's going to come up in a lot of the planning is the step transaction doctrine. Way too many clients don't pay any attention at all to how assets are titled. So you may have assets in joint name that have to be divided and then almost immediately put into irrevocable trust by each spouse. You may have assets in spouse one's name and they divide them, putting some in spouse two's name, and then spouse two makes irrevocable transfers to irrevocable trust. Step transaction doctrine, timing issues, those are things we're not going to be able to control. I think it's very important to emphasize, because there's been so much talk about slats, that you don't need to do a slat for both spouses. Just as Jonathan said, do a slat for one, do a hybrid DAP spat or hybrid DAPT or spat for the other spouse, so that you've differentiated them with a very significant, or DAPT for a very significant difference between the two trusts. And another way, by the way, that you can fairly quickly differentiate trusts, and any insurance consultants on this call will love me for this, have one trust buy a large chunk of insurance. Don't forget, the economics of these trusts is a factor in differentiating, I think, the reciprocal trust doctrine. And if one of the if a slat owns a $10 million 20-year term policy, and the spat for the other spouse has no insurance, the economics of the two transactions are quite different in terms of funding and how each spouse is different post-transfer. So there's a number of things that you can consider doing. Just another final comment Jonathan had suggested, which is very important. You need to evaluate whether one or both spouses makes a gift. If the client's worth $100 million, it probably is, I think, crazy or a mistake not to have both spouses use their full exemption. For spouses in the $20-30 million range, maybe even higher, they may be not comfortable giving more than 11.7. So Jonathan's thought of having one spouse use their exemption and preserve $6 million for the second spouse is a lot better than splitting it. But let me just give one little spin on that. And I'm seeing this with a number of clients. So spouse one may use as close to their 11.7 of exemption that they're comfortable with, and spouse two will say, gee, I'm not going to do a trust, and I'm going to just hang on to my $6 million inflation adjusted exemption. I would tweak that suggestion just one bit. I'd have the second spouse that's not looking to use much exemption still nonetheless set up a very robust slat ILIT, a slat with ILIT provisions, put in 50 grand, put in 100 grand, whatever they're comfortable doing, not so much to use exemption, but why not get a grandfathered grantor trust in place? We don't know what that may or may not do, but if the client's worth 10 million, 20 million, 30 million dollars, the incremental cost of doing a second slat just to have a grandfathered grantor trust may be well worth the cost. And I would take that a step further. Clients should be thinking about having G2 and even G3, if they're adults, set up grantor trusts, even if they only put 10 or 20 grand in it. Why not get a grandfather trust? If G2 is, in their 30s and has a young family and they weren't going to set up a trust because they don't have a lot of wealth, why not set up a robust in terms of flexible provisions slat with ILIT insurance provisions, put in 20 grand, whatever. Now you have a grandfather trust. If they want to fund a typical life insurance plan in future years, they may be able to use split dollar loans and do that. So I think there's a lot of planning, and we don't have a lot of time to do it. And how do you make that happen? So I've typically preferred to set up irrevocable trusts in any of the 19 jurisdictions, as Jonathan talked about a few minutes ago, that permit self-settled trusts. I just think it's safer for a whole bunch of reasons beyond what we have time to talk about. But for clients right now, I may set up home state trusts with Uncle Joe as a trustee of one and Aunt Jane as a trustee of another, and give the trust protector the power to change situs in governing law. Why? Because we may just not have time to get an opinion of counsel in a trust-friendly jurisdiction. I mean, I think you still do, but those days are waning fast. Don't forget, if you're using an institutional trustee, they have to review it. Some of the administrative trust companies will give you like next day turnaround, but again, they're going to be deluged. So just keep your eye on how you structure a trust. You may want to do a home state trust with family members, even if that's not your first preference, at some point in time. I don't know that we've gotten there yet, but just keep your eye on that as well. Comment on 16. Don't think that slats are only for spouses. You can use them for anybody. It could be a sibling lifetime access trust and so on. Who wants to talk about 2032A?
Very simple. Today, we did this for a farmer in the county south of us on a 706. We took a deduction for $750,000. Looks like that's going up to $11,700,000. That's a great start. I did some work for some lawyers, a presentation from lawyers in Nebraska earlier this week. They're very grateful for this change, but they point out it's $16,000 an acre. There's a lot of farms that this won't cover. So, but it's a good thing. So if I died and I was a farmer and I had 12 million of land, I would only put basically 300,000 of that on my federal state tax return, Marty. So that's the beauty of this change.
So let me ask you and maybe Jonathan a question, because I'm trying to contemplate. If somebody has land that will qualify for this, do we want to not have that land given to a trust to use exemption? Is it better to keep qualifying real estate farm property in their estate to get this benefit rather than transfer it to a trust to use exemption? And if the answer to that is yes, do we want to consider talking to clients that have already put qualifying property in trust and suggest they swap it out while they can, because they may not be able to do that post enactment, to get this back into their estate? Thoughts?
Well, I don't think swapping it out, Marty, is going to do them any good. I mean, they've used the exemption, and I don't think that they can take it back. But the exemption, people, maybe somebody put in her 11,700,000 ranch or a farm property. She's used it. I think she's done it. I think that's where she stays. There's not going to be any step up in basis, but the code also provides that to the extent you use section 2032A, you don't get the step up in basis otherwise. Also, I can tell you, because I've had some experience with 2032A, it is a complicated administrative matter. So if you've already given it away, I think you're better off doing that. But most people can't afford, who are farmers or ranchers, can't afford to give it all away and give up the income on it, which would cause a state tax inclusion. But this will provide tremendous relief to probably, I'm going to guess, 99% of all farmers and ranchers in the United States, keeping in mind that if you're married, you basically go back again to 24 million of exclusion under section 2032A. It's got to cover virtually all family farms and ranches in the country.
So now let's get into the real heart of the issue. The legislation would add a new code section 2901, which would cause grantor trust to be included in your estate, the estate of the grantor, Or if you try to cleverly get out of that by making gifts or turning off grantor trust status, that is going to get you too. So basically, any grantor trust after date of enactment would be includable in your estate. Now, this raises a pretty big question with life insurance, which we're going to have to take on. And right now, one of the things, maybe a fourth thing you can put on your list below immunization and tax planning is, let's say you have a client, Mrs. Johansson, she needs to fund an ILET to the tune of $100,000 a year, and it's a grantor trust. If she has the money, maybe she should put 10 or 15 years of payments in that ILET tomorrow morning. And because then we could keep that totally grandfathered. Jonathan, I know you've been doing a ton of work in the life insurance area. How are the big carriers looking at this, and what's their plan for life insurance going forward? Because it's going to look different than it has for the last 30 years.
Well, the industry has been very concerned about the loss of the tax-free step-up in basis and has lobbied very hard to keep it because they're worried that if they get rid of the tax-free step-up in basis, maybe someone will say, well, why are we going to allow Section 101A1 to continue, which is a complete exclusion of proceeds of life insurance paid upon the death of the insured. They very much want to continue to have that. That's critically important to the industry. And it is an extremely important thing to clients. But I can tell you that you are going to have to do one of three things if you have a life insurance trust. Either you're going to have to do what Bob says, which is pre-funded, or you're going to, because if you have a pre-existing grantor trust, yes, you're grandfathered from this new section 2901, so you don't have inclusion. However, if you make an addition to the trust, you're going to have inclusion. We're not even sure how you would determine that. Would it be based upon the value of the trust immediately before, which if you have, for example, a term policy could be extremely low, or would it be based upon proportionate premiums paid? We don't know. But the best thing to do is, to the extent your client can afford to do it, prepay your premiums. Even if you have to borrow to do that, that probably makes sense. Or turn off grantor trust status, which will not be easy, especially if the trust includes the benefit of a other spouse. So if I've created an irrevocable life insurance trust for my spouse and kids, it's going to be a grantor trust. Very hard to turn off grantor trust status, although perhaps by some sort of decanting, I could say that my wife could receive distributions only with the consent of an adverse party, which would eliminate presumably section 677A1 and A2. Of course, if you don't prohibit the payment of income of the trust, including capital gain, in the payment of premiums, you're going to have a problem potentially with the IRS as well. That's one of the things you have to do. The third thing you can do, especially for large premium payments, is to do a split dollar loan. The rules on split dollar loans are set forth in Regulation 1.7872-15. Important to write that down, 1.7872-15, which says basically if you make a split dollar loan as described in that regulation, it will not be considered an additional contribution to the trust, or at least that I believe that's what it says, which means you don't have to worry about an additional contribution to a pre-existing grantor trust, so you can avoid section 2901. This is complicated. You're going to have discussions with all of your clients, because many practitioners, both lawyers and accountants and life insurance people who have been out there, have been urging their clients to do irrevocable life insurance trusts. And now all of those have the potential of coming back, at least in part, in the estate of the grantor, because an additional premium has been paid, which will be considered a post-effective date contribution to the trust, which would cause section 2901 to be triggered.
So, Jonathan,
let me add two comments to those points. First, Bob used in his example a $100,000 transfer to a trust. You may have small clients where they're putting in 10 grand a year, using a crummy power, calling it a day. Now, the Sanders proposal had talked about capping gifts to trust at 2 times the annual exclusion amount, which would be 15 times 2 or 30,000 a year. I didn't see that in the House Ways and Means proposal. That may come back or not. But the point to keep in mind is, even if the assets that are going into the trust qualify for the annual exclusion gifts, you're not going to be able to avoid the consequence that Jonathan said. So even if you get a crummy power and it still works and they don't restrict that, or you're underneath the restriction, that's still an addition. So you still have a pro rata portion of the trust included. So you're not out of the issue that Jonathan talked about. Another point, Jonathan correctly talked about 78-72-15 in terms of using split dollar loans, and all of us will have to be expert at that. The reason you want to use a split dollar loan, you could make a regular loan, and in some instances that may work. So if you have what I'll call a slat islet, where you've given millions of dollars of assets to a robust slat that also has insurance provisions and holds insurance policies, that may be fine because there may be seed capital. Most life insurance trusts have no seed capital at all. They have a $100 bank account, and they have traditionally gotten a check gift each year, crummy power issued, and then premium paid. That could be an issue when you try to make a non-split dollar loan. You're going to have to go through all the criteria and prove that it's a valid loan. If it's not a valid loan, the IRS could recharacterize it as a loan instead of as a loan into a gift, and then you now are back into these new provisions that cause the state inclusion. The beauty of what Jonathan said under 78-72-15 with the split dollar loan is if you follow the cookbook, if you follow the recipe and the regs, the IRS cannot change the characterization of that advance to the trust as being anything but a loan. So we're all going to have to be expert in that. And Jonathan, unfortunately, is correct that post-enactment, when clients want to set up an insurance trust, the typical ILIT will not work. We're going to have to set up a non-grantor trust, and that's kind of complicated. Just to emphasize that, keep in mind that one of the reasons we've all liked to use grantor trust for insurance is the flexibility in the transfer for value rule, the flexibility. I could sell a policy to a grantor ILIT and avoid the 3-year rule. Can you really do that? If you have a non-grantor trust, you're going to trigger gain. And frankly, post-enactment, if a transaction between a grantor and a grantor trust, even a grandfathered one, is going to be treated as a transaction with a third party, avoiding the 3-year insurance inclusion rule by a sale will no longer be possible. So insurance planning is going to change dramatically, not just for the super wealthy clients, but for all of our clients. It's really going to be massive.
But, can we go back one other slide though? Back to 19, please. Now, the other thing that's happening here is there'll be code section 1062. Basically, if I sell to my grantor trust, the IRS has going to ignore revenue ruling 8513, and that is going to be a taxable sale. So if I have even an existing grantor trust and I sell $1 million worth of property with a basis of $100, I'm going to have to pick up that $999 gain or $999,000 gain. This is an incredible change. And Jonathan, I know some of the things that came out of the AgTech meeting on the Hill yesterday affect this. It's even possible that this change could apply to installment sales that were put in place 5 or 10 years ago, right?
Well, that's right. I mean, let's say I had set up a grantor trust. I had done an installment sale. Maybe I reported it to the Internal Revenue Service on my gift tax return. I reported it perhaps on the income tax return saying it's not taxable because it was with a grantor trust. All of that is good. The returns, the statute of limitations on the return is now expired. I think I'm golden. But now when that has to be paid off, it means that you're going to have gain recognition if you use appreciated assets, which you almost always will, to pay off that note. Very, very harsh result. And I think they're going to have to provide some sort of, or at least I hope they'll provide some sort of grandfathering for those kind of transactions. This could be very, very harsh indeed.
But for example, if right now I had a trust, existing trust that had $1 million worth of cash and it owed the grantor $800,000, even though there's a built-in gain on there, I might be very wise to just go ahead and pay that off if the economics permit. Is that fair?
I think that's very fair, Bob. But again, with most of these trusts where you've had large installment sales to the grantor trust, you're probably going to have a lot of appreciation and you were planning to pay it off with appreciated assets. And keep in mind that when you die, at least under current law, there will be no tax-free step-up in basis at death. So you're going to be stuck with those low basis assets, no step-up in basis, which means you can't even avoid the gain recognition by waiting until the grantor has died.
But going even deeper, I think there's two parts to this. So if I sold to a trust before and I had a gain on that transaction, and then the trustee pays me back, I might have to recognize that gain. That's fair, right?
Right. Well, we're talking, if you make a sale to a trust, presumably it was not an income tax event because it was a grantor trust.
Right.
Under ruling 85-13 and the regulation under 1001, no gain at all. That's a great result. But now the note has to be paid. And if it's paid during lifetime with appreciated assets, and this provision goes into effect, and it's presumably after the date of enactment, which would be when the president signs it into law, unless perhaps Senator Van Hollen gets his way and it's all made retroactive to the beginning of this year, you'd ultimately have gain recognition. So Bob, as you said, maybe you should consider having your installment sales paid off this year with appreciated property before the law changes. But we just don't know. I mean, it's very, very frightening to think that these things could be retroactive to today. That's not what's come out of the House Ways and Means Committee. It's not what President Biden proposed. He only proposed that the increase in the long-term capital gain tax rate to 25% becomes effective retroactively to, I think, September 13. But if you have people who've done installment sales to grantor trust, you need to consider having those paid off today. Although, again, there was an indication to the representatives that they realized they're going to have to provide some special grandfathering. This goes back to what we were talking about with grantor retained annuity trust, where you've had a grantor retained annuity trust set up. You now want to pay off the annual annuity payment with appreciated assets. And that's what you plan to do. In fact, you may have been doing it all along, but now you can no longer do it if this passes unless they provide some retroactive relief.
Jonathan, you had inherent in your conversation that the payment that would trigger gain will be an appreciated asset. If we have a note sale that was done 5 years ago, it's disregarded, but does that still exist as an installment sale? If you pay it back with cash, not an appreciated asset, does some portion of that gain get recognized under any of these versions of what they might do? Why
Marty,
we have a worse problem?
Marty, I'm just not sure. You know, this
that would be a disaster. You can't even
well, of course it would be, Marty. So, you know, take cover. But, you know, one of the things is that some of these proposals, especially what came out for the House Ways and Means Committee yesterday to the representatives that met with them, is maybe it's basically trying to prohibit people from doing planning, because no matter what you do, you may have a very bad effect. So maybe they're trying, you know, I kind of felt that Senator Van Hollen made his proposal retroactive to say, I'm going to prevent you from doing any more planning during 2021. We simply don't know. And remember,
but Jonathan, this is worse than not doing new planning today. This is saying if I did a note sale 5 years ago and I've only been paying interest, when I pay the note back post enactment and it's treated as if it's between me and a third party, will repaying that principal of the note, even in cash, trigger the deferred gain that was not recognized initially because it was a grantor trust at the time, and now because it's a third party repaying the note, it's like an installment sale and the gain's recognized? I think for installment treatment, you just need to have 2 payments or deferred payment. Could that deferred gain be recognized?
Marty, that is a great question. We don't know the answer to that, but there are certainly some people, I'm sure, who feel it should be. So if that's
the case, Jonathan, if that's the case, should clients consider going out to a bank, having the trust borrow money and repaying the note today? Because otherwise they could have this massive gain when the note's eventually repaid?
Maybe they should, Marty, but it's simply not going to happen. People are not going to go out and borrow cash unless they have an entity they can borrow and effectively tax-free and pay off the note today. I don't think that's going to happen, regardless of how large or how small that outstanding, previously unrecognized installment sale was. That would be an exceptionally harsh result. But again, we have to run the gauntlet, not just through the rest of the House of Representatives, where Speaker Pelosi said that there will be changes, but it's going to have to run the gauntlet of the Senate. And the Senate, with Senator Wyden and with Senator Van Hollen and Senator Sanders, you may find that there are some very harsh things that come out. But Marty, I think what you suggest could happen. I don't think it will happen, but I have no clearer crystal ball than anyone else does.
What a disaster. What a disaster.
So basically, future grats are done and future idjits are done. You can clearly see why the idjit doesn't work because of the inclusion in the estate. And then I thought everything would pivot to grats, but not true, because I'll create a grat. That's a grantor trust. At the end of the grat, it flows into another grantor trust, and that second grantor trust will be included in my client's estate. So that's a disaster. Well, somebody like Jonathan or Marty would be clever. They'd say, well, we'll turn off grantor trust status. The statute envisions that. Well, we'll give away everything during lifetime. We'll get it all out of that trust. The statute envisions that. There is no door out of this room. That's the bottom line. They've sewn this nice and tight. Going forward, our planning techniques will be basically using installment sales to non-grantor trusts and to making taxable gifts, and undoubtedly other ideas, split dollar, etc., will percolate to the surface. Well, we're almost done today, Marty and Jonathan. What other comments do you guys have?
Well, I think the most important thing is to talk to your clients, tell them that no one knows, that it probably makes sense to use their full exemptions to the extent that they can comfortably do that. That one thing that appears to be it. The question is, can you use appreciated assets, or we're going to have Van Hollen come in retroactively as he proposed back in March, so that if you fund a trust today with appreciated assets, you recognize gain, whether it's a grantor trust or not a grantor trust. We simply don't know what's going to happen. I mean, there are going to be impacts on all sorts of charitable split interest trusts. It may be that the charitable remainder trust becomes a darling again as a way to avoid it, but it is possible that the transfer of appreciated assets to a charitable remainder trust itself will be a taxable event. The thing is, stay tuned, keep your clients informed, and I would suggest that if you are considering a transaction, maybe this is the most important thing that I will say, get everything set up. So there will be some time, there will be a day or two or three, by the time the reconciliation between the Senate and the House occurs, before it goes to the president to be signed, to determine whether or not there's an opportunity to do something without being caught by some of these very onerous new rules.
I think we need to focus on making sure clients, unless they're sufficiently wealthy, have access to trust, don't get caught by the short-sighted planning that commonly happened in 2012. I think it's critical that we do whatever we can to differentiate trusts from the reciprocal trust doctrine. It's still out there. I think we need to be cautioning clients that we can't control in some instances the step transaction risk because of the timing of what they're doing and the compressed time frame that we're planning in. I think all the bells and whistles, from incorporating into transfer documents the right to rescind the transaction if there's an adverse income tax change enacted that's retroactive to the date of the transaction, including disclaimer provisions, and that's another discussion because there's a lot of different views on that, into irrevocable trusts, using formula clauses. There is still tremendous uncertainty. So the more flexibility, the more access, the more ways to unravel, which is things that we've been talking about. I think all that remains that we should consider, and we should proceed to plan to the extent we can and see what we can do to help clients. And I think it's going to get to be a crazier and crazier year as the time progresses. Bob, any final words from you?
4 quick points. One is, sales and transfers, gifts before enactment, doing swaps, the whole idea to immunize trusts, trust income tax planning beginning in January, and pre-funding ILETs. I think that will be the cornerstone of where we go forward. This has been Jonathan Blockmacher, Marty Shankman, and Bob Keebler discussing 21 tax reform, what the estate and trust lawyer needs to know. Thank you for joining us.
Good luck, everybody.